top-down ICT approach. Okay, and also, as we've always mentioned before in previous examples of education in my work, everything hinges upon the interest rate market. Okay, whatever you see in the interest rate market will have a driving force in the United States dollar index, which is essentially the barometer for foreign currency markets. If the US dollar is weak, that bodes well for bullish foreign currencies. And if the United States dollar is bullish, it bodes poorly for foreign currencies and expect lower prices and sympathy. And obviously, that chain of command maintains its impact across all market asset classes, that being the stock market, the commodity markets as well. It's not limited to just currency markets. So obviously, what do I mean by it all hinges on the interest rate markets? Well, we watch the 10-year, 5-year, 2-year, and 30-year markets and the yields. Okay, and by looking at the yields, what we look for is generally the yields are moving in tandem. Okay, and in this example, crudely exampled, we're looking at a downward shift in yields. So that would indicate that yields are dropping. That is a risk-off scenario. So while risk is off, we are no longer looking for buy signals. We're focusing more on the sell side until we see a divergence in the yields. Okay, now this could take form in a 5-year. It could be in a 10-year. Generally, you want to be looking at 3 yields, like for instance, like I trade the British pound and the fiber. Well, it's crossed with the US dollar, so the yield triad that I use is the US yields, the UK yields, and the German yields, as described here in this, again, rather crude example. At some point, and usually between 2 to 3 months, a couple times a year, there's a shift that takes place in the interest rate market, and it's quarterly driven. So at some point, the yields will fail to make comparable lows. Okay, and just think more or less Dow theory. That's what I've applied here, is they have to confirm one another. If they don't confirm one another, something's taking place fundamentally. I'm not claiming to understand what it is fundamentally that's taking place. I'm just stating that I see it in the chart following the yields. So when one diverges, in this example, you see that the UK and the US yields failed to make lower lows, while the German yields did. Okay, that's generally an indication that the German markets are less favored, but yes, they probably will move up in sympathy. So now we see a shift underway. Now, as the yields are increasing for the next quarter, this generally will be bullish for foreign currencies and or bearish for the US dollar. And this will maintain its impact over the market for a period of time until at some point the yields will encounter a resistance level of some kind. And that's going to come in the form of one yield failing to make a higher high and or more than one. Okay, so what you're doing is you're looking for a shift in the overall trend of the yields. Okay, so it's going to tip your hand that something fundamentally is slowing down. There's waning interest in risk, and there may be a turn likely to ensue. So now you want to be a little bit more cautious in your buy signals, because we may see a drop in yields, which would be a risk-off scenario, and then the dollar should be rallying at this point. Okay, so these are the concepts that you have to apply, beginning with your top-down analysis, understanding are we in a risk-on or risk-off scenario overall in the interest rate markets. And then once we have that, we can look at a more macro view down to a micro view. All right, we are obviously beginning all of our analysis with the interest rate markets, and you don't want to have to expect this to shift every single day. Okay, you want to be having a higher time frame macro view on interest rates and monitoring that based on our buy signal. Are we in a buy program or sell program? Next, obviously, we would be considering the direction of the United States dollar and the technical levels that that indice is currently being impacted by. Obviously, it helps to trade with the understanding that's found in the futures market, that being the treasuries and or T-note markets, that being the 5-year, 10-year, and 30-year treasuries. The stock indices are always good to watch. I go from interest rates of the US dollar to treasury markets, and I check out what the overall risk tone is in the stock market. Are the averages, again, confirming using Dow theory? And if they're not, it may be an indication that there may be a short-term and or longer-term shift taking place in the marketplace. Then I obviously look at the CRB index. I try to get a feel for, are we still in a risk-on, risk-off scenario that's confirmed with the commodity markets? And if the CRB is bullish, that would indicate that we are in fact risk-on, and that would be bearish for the dollar and bullish for foreign currencies. And obviously, it always helps to look at a few other select markets like gold and oil, because those are good barometers for risk-on, risk-off as well. For the anticipatory stage, okay, the first stage of analysis is always going to be the anticipatory stage. Okay, you're going to spend more time in this stage of your analysis than any other stage, and it begins with seasonal tendencies. That could be the are we in a bullish quarter or a bearish quarter based on price action? Are we in an area where seasonally we expect prices to rally or decline? There's a seasonal tendency that takes place in generally every marketplace there that is tradable, and it's my advice to use that, to learn what they are. And I'm going to share with you a few of them that are very strong in this this presentation. Over the course of this presentation, you're going to learn more, but you have to have an understanding of where we are seasonally. And obviously, while we're looking for seasonal influences in the marketplace, you're always watching that yield SMT. Okay, in other words, looking for the triad to be diverging, comparable to the highs. In other words, one's going to fail to make a higher high, and that's going to give you an indication that we're probably seeing a shift from risk on to risk off, and vice versa. Okay, and we always look at correlated pairs that we trade, and it's good to be a specialist in market trading, because it's not, to me, it's never been advantageous to be a trader in every market. Okay, because you can't watch too many things at one time and have a really good relationship with the marketplace. If you're spread too thin, obviously, how are you going to get a fix on what's going on in price? So be a specialist. Pick one or two markets that closely correlated, strongly correlated, and then basically trade likes. Look at correlated highs and lows. And obviously, you and me looking at the stock market indices, NASDAQ Composite Index, the S&P, and such. Okay, every week you want to be maintaining a watchful eye on the COT, and we watch the net trader position. Okay, the overall net position, are they bullish or bearish, and are they lessening or increasing their shorts? That's going to be an indication whether or not the market is in fact bullish, bearish, or if the current market moves has been on their way is in fact legit, or if it's not. You always watch the open interest and the premiums between the nearby and next month out on your currencies, and you're going to be looking for indications that there may be a strong demand for, or waning demand, if there is a premium for that particular market. Market sentiment, obviously, this could be derived at using online market vein numbers. We can look at sentiment based on chatter that's going on in the news, the forums, talking heads on TV. If everybody's expecting the same thing, it's generally going to be the other way. And obviously, we always have a watchful eye on key higher time frame support and resistance levels. That is the daddy of all things that we do in technical analysis. Understand our key support and resistance levels. All right, the execution stage. Before we take any trade, before we do any order entry, okay, once we have a higher time frame top-down analysis done, we have an understanding of where we are at in terms of yields and interest rates. Okay, we got to get, for the day that you're going to actually be doing any trading, you still get a major market tone. In other words, are we still bullish overall going into the new day? And what do I mean by that? Well, are we risk on or risk off? You have to understand this, because if you're buying generally in a risk on scenario, that's good. But if you're buying foreign currencies in a risk off scenario, you have the tide moving against you, and it's very, very difficult to make money in that situation. So it pays to understanding what it is that you're doing every single day, and judging on what the market's doing going into London. Are we rejecting highs? Are we rejecting lows? Probably pricing in the daily low, daily high. You want to be trading in that directional premise. And obviously, it goes without saying that if we have a buy or sell program on a higher time frame based on directional premise on monthly, weekly, daily, and 4 hour, and if we're in a buy program rather, you want to be focusing on the buy signals. Obviously, we have to have our macro support and resistance levels from the higher time frame, monthly, weekly, daily, 4 hour, and 1 hour on our sub 60-minute charts. So in other words, our 5 and 15-minute charts have to have these higher time frame support and resistance levels in the chart. You have to see them, be aware of them. Okay, don't just have them written on your piece of paper. Have them on your chart. Look at them, know where they are, where they're at, and you'll get better feel for what price is actually trying to do. Market structure. Okay, before we execute, we have to understand where are we at. If we're bullish, we're looking for intermediate-term or long-term lows on the left-hand side of our chart. Okay, so we're going to be looking for short-term to intermediate-term lows to be keying off of to get ourselves in sync with the higher time frame macro view. Okay, and market structure is a key role in that understanding and execution and your trading. If you're bearish, okay, you want to be seeing a long-term or intermediate-term high on the left-hand side of your chart. And where you're trading now, you want to be shooting for intermediate-term highs or short-term highs to be getting short and getting in sync with that overall market structure that is bearish. The market flow, obviously, we have to understand, simply because the market is poised to trade higher, and technically, yields may be moving up and risk on. All those things are in place. Support has been traded to. It makes it a lot easier trading if we use market flow in a higher time frame, 4 hour and daily, to make sure that we have the tide in our favor. Okay, and once it starts moving, it makes trading a lot easier. Okay, so if we have a bullish market structure, bullish market flow with a bullish macro view, okay, and we're trading with risk-on scenarios in a buy program. Now, simply moving to a simple time and price theory of expecting the low to form during London, okay, you can expect the Asian range to be a very key role in your order placement. You'll be looking for the Asian range high or less to look for your buy signals, and vice versa. If you're expecting a risk-off scenario, you'd be using the time of day principle of the Asian range low or greater, looking for a Judah swing up, and looking for your shorts to be anywhere in the London Open and or the New York Open sessions to be keying off of that directional premise on the higher time frame, drilled down through all the steps we just covered here. More detail obviously will be given as we go through actual real top-down analysis and real breakdown of a market move that took place in the spring into the summer months of 2012. But for now, what we're doing is we're outlining really the top-down approach in a nutshell, so that way you, going into your charts every day, this is the framework that you should have in your psyche as a trader. What it is that you're doing every day on a daily basis. Is it the same thing over and over again? This is my routine. You may tweak it a little bit. You may take some things out of here and move it around, do something a little bit different in terms of order. But these are essential to me in terms of my concepts, my material, the things that I use when I do my analysis. And then finally, once we understand what we're supposed to be doing based on our time frame premise, it goes into our order entries, okay? And 90% of the time, I'm using limit orders to get in and get out, and stop orders for protection. And unless I'm trading a breakout and I want to use buying strength or selling weakness, okay, that's the only time I'm using a stop, and that's 10% of the time. So what does that tell you? 90% of the time, I'm not trading breakouts, okay? I'm actually fading the market moves. Trade entry orders, we're going to talk about that in the last module, because we're going to actually give you specific orders and specific examples on how to use these orders for actual demo trading counts. So you can practice in the sandbox and see whether or not these things work for you going forward. All right, the reactionary stage. Right there, basically there's times in the market where if you're in the trade, okay, and you have little to no movement at all, you've anticipated a market move and price just goes stagnant. It goes nowhere. It just starts going sideways, okay? That's a time for you to more or less kill the trade, especially if you're expecting a price move and we're moving into a specific time of day where volatility should be increasing, but it isn't, okay? It's just better just to close the trade. Do not expect your success to be hinged upon one single event, one single trading day. Okay, and I think if you really take a look at your heaviest losses, look at your biggest losing days, okay, or your string of losing days, I guarantee if you go back, the mindset you had going into that trade is that you are expecting and hoping and praying that this move is the winner. This is going to be the one that puts you over the top or gets you back to even, okay? Don't think like that, okay? Demand the tools to place you in optimal trade entry. If it doesn't provide you that, and you don't see a very short to near term feedback in your trade, in other words, are you seeing the things that you're expecting in terms of volatility? Are you seeing a rejection at the lows that you were buying into? Are you seeing follow through at the upside after you bought that long? If you're not seeing that and it's going stagnant and you're getting close to the end of the day, going to the London close, or if you're going into New York Open, okay, and prices is stagnant, it may actually bounce up against you if you're short, or if you're long, it may actually pull back against you, or it could just go into a longer term consolidation. Why sit in that? Okay, if it's showing you failure to move, that's your time to react. Kill the trade. There's no risk now. Okay, if it runs off and if you would have stayed in and made money, big deal. Let it go. Okay, but we act quickly when trying to preserve our capital. We act slowly when we're trying to make money. Okay, we want to be methodical. We want to be very, very focused, okay, and detail oriented when it comes to exposing our money to risk. We want to really put it to work when there's something highly probable in our favor to take advantage of. Why risk on very low odd setups? There's no reason to. There's enough of them happening in a week, there's enough of them happening in a month, and over the year, good grief, you have tons and tons of opportunity to make money. Don't sit in questionable trades. If it's not moving for you, kill the trade, take another setup. If you see rejection at a key support level that's counter your expectation, or you're in the trade, kill it. Why eat up open profits? Okay, turn your paper profits into literal profits. Go to cash, move to the sidelines, take your profits and get out. Okay, if you see rejection, strong rejection, something comes across the wires and hits you unexpectedly, which in the event that a major catastrophe or a global national event, something of that nature, that could rock the markets. You never really know when that's going to happen. So if you see that, it's just better just to collapse the trade and just get out. You can always get back in, even for those folks that are in carry trades. Okay, you can get back in those moves. Okay, and look what happened in Japan. If you know the earthquake hit, tsunami took out reactors, and the whole world's waiting for Japan to slip into the ocean and dissolve. Those things we can't expect them. They're acts of God, so we have to more or less just take ourselves out of the risk environment, okay, and stand on the sidelines where there's no more risk, okay, and we can hopefully gain a more objective view of the marketplace and then react with objective analysis, not reactionary gambling and trying to get in there and throw the dice and chase the market chasing mentality. That's not how we make money. Okay, you want to react by getting out and take yourself out of the risk. And obviously, if you're sick and if you have a life event that takes place and requires your time, your kid might have something that requires you as a parent, or your spouse needs you to do something with them. What takes precedence is your relationship in the real world or the charts. Okay, because hopefully, I appreciate you guys want to spend time with me in these video modules, but I certainly enjoy it. But I enjoy my family more. And if it's going to be a choice, whether if it's you and YouTube and baby bits, it's going to be my family. Okay, so if something takes place that requires me and my time, or if I get sick, you got to react. And if you're in a trade and you just think that you're not going to be able to adequately manage the position, react responsibly and just collapse the trade, and or tighten up the stop loss, so that way if you do fall ill, or you fall disconnected to the marketplace because of life events that take place, maybe there's a death in your family, you're going to be able to think objectively during that. Okay, grief can have a major impact on a trader's psyche, and it's just better to just more or less remove yourself from the risk. Okay, and you can always get back in. Alright guys, fractal analysis in price action. Alright, what's a fractal? Well, a fractal is a pattern in nature and in many things that, as a Christian, okay, I believe there is a creator, okay, and I give thanks to him on a daily basis for the insights that I've been blessed with, and I share with you. And I think that fractals are one little signature on his part, also to show that there's a design to this. Okay, everything around us has a specific design. Okay, it shows intelligence behind it, and everything in nature has this same phenomenon. It's much like Fibonacci, but a fractal is defined simply as a pattern that is repeated in infinite size, up and down. In other words, something that you see on one scale, okay, if you scale into it and zoom in, you can see its same pattern repeated on lower levels. And obviously the same thing if you magnify it out and look at it as a macro view. Well, that same principle is in effect in price. Okay, and price, because, and I'll give you a real generic way of viewing it. When I say price, okay, what comes to mind to you? Is it a daily chart? Is it a 1 minute chart? Is it a tick chart? For some of you, it may have been a weekly chart, or it could have been a 5-minute chart. It doesn't matter what time frame that we are referring to. It's always just the last price. Think about that. You're looking at price right now. At the time of this recording, the cable's trading at 161.74. That 164 by itself absolutely is useless to you, unless you have a understanding of where you're at in terms of the big picture. Okay, by having the big picture and using a higher time frame perspective in your analysis and understanding key support resistance levels, you can go into the marketplace and see patterns that repeat over and over and over again. There's specific fractal patterns, and I'm not going to reveal them all in this module, but you'll have a few of them shared throughout the presentation over the last few parts of the series. But the fractal analysis concept can be applied to the simple optimal trade entry. Okay, what does that mean? How do we go into the marketplace looking for a fractal? What is it? Okay, it's one thing that myself and other folks to understand fractal analysis, we can go in and show you a chart in hindsight and say, look, this is where this did that, this is where this, that's great, okay? But without a firm understanding of what a fractal is and what it looks like and how it's applied to the marketplace, it's not going to do anybody any good. Okay, so this section is really just going to highlight an example of one form of a fractal. Okay, and there's all types of fractals. There's many different kinds of fractals in terms of price action. But the main thing is if you can't understand what a fractal is on a higher time frame premise, okay, it's going to mean little to no good use to you if you're trying to apply it to intraday charts. Okay, so what am I saying here? Okay, well, in this example, we're going to talk about a fractal. Okay, and this is going to give you a price swing, and we're going to more or less break it down and show you more insights on how price in itself works within a fractal nature. All right, we're looking at this could be any price, any commodity, any stock. It could be anything. but for now we're just going to talk about this being a currency pair. Okay, so price is trading within a specific range. Okay, and we notice that above where price is currently, this is a key resistance level. Okay, one would expect if we're this close to it, price would eventually try to run up to that key resistance level. Now, as price runs higher and approaches that resistance level, at some point it will hit that level. We as traders and technical traders, we would expect reasonably there would be a pullback or a bounce away from that particular price level. At some point, price will come down in that retracement, okay, and swing low, make a small little short-term low. When that takes place, we now have a new reference point for short-term support, okay? Now, obviously, if we have short-term support here and a key resistance level like that, a technical trader like we are, or aspiring to be, when price is starting to bounce again on a short-term basis, we could reasonably expect or anticipate another retest or run attempt to get back to that resistance level, okay? At some point, it may get up there and blow through it, but on many times, it will fail to do that, okay, and then start to come back down again. Now, here's where, if you understand optimal trade entry, and which is basically a 62 to 79% retracement level on a price swing, if you see this, this could lull you into believing that this could be perhaps a bull flag. It could be perhaps another ABCD price extension, okay, or it could be a top. Okay, we have to go back to the higher time frame resistance level. That takes precedence. That is the one that we have more emphasis behind, not the short-term little blips in the marketplace. Okay, we expect sellers to be heavier in the market than buyers. Okay, and we anticipate price to break below the low here. Okay, if we see that break below, okay, that's going to give us a shift in what? Market flow and market structure. We're looking at a market that's breaking down if this low is taken out. Now, if price does break down lower and breaks through that, now we are confirmed we have a bearish market flow and a early market structure reversal. Okay, so now we could reasonably expect this higher time frame optimal trade entry. Okay, that would be the higher time frame turning point, and now we could look for continued sell signals. Okay, so we see here a very standard optimal trade entry top formation. The market broke down. Okay, in itself, this is a fractal. Okay, look at this pattern right here. This in itself is a pattern that is applicable in fractal analysis. As price breaks down and moves further lower, okay, go back to the concepts we just learned in part 2 of the trading plan development series: range contraction, range expansion, and trading range to trend to trading range to trend. Okay, so consolidation to trend, consolidation to trend. In this region here, even though we saw price movement up, down, to make that optimal trade entry formation here, that's still a consolidation. See the range here? That's a consolidation. This move here is the trend, okay, or the price swing out of consolidation. So now, when price breaks down like this, what do we as technical traders expect to see? Another consolidation. So what's going to take place in the consolidation? It's going to be a bounce. It could trade up to another resistance level, okay, which would be an old support. And price will eventually trade back into a consolidation, okay, and we can now look for, inside this consolidation, smaller, short-term optimal trade entry tops. Think. We have a higher time frame price leg that's already turned on a higher time frame key support and resistance level. As price broke down, we are now, in our minds, focusing on lower level 5, 15, 1 hour basis optimal trade entries to look for what? Lower prices. Okay, so by having this mindset going in and trading during consolidations, we're essentially limiting our exposure to the market by only selling short, basically an established weak market. Okay, and we have a bias going into our analysis, so we're not going to be subjective and just be lulled into buying and selling simply because the price is doing whatever it's doing at the time we sit down in front of our monitors. We are focused on one specific process, and we have the higher time frame support resistance levels on our side. We have the fact that we have broken market structure, market flows on our side. Okay, because now think, just looking at this price chart right here, if this is a currency, market flow is still bearish until we take out this swing high. Before this swing high formed, market structure was still bearish until this swing high was taken out. Obviously, we keep making lower lows and lower highs, and we maintain a sell scenario in our trading, looking for shorter term, where it's lesser time frame fractal pattern of optimal trade entry tops. Okay. Again, price will stay within this consolidation, and as price moves up, inside of each one of these price legs, every single one of these, if this is a daily chart, every one of these smaller price swings in here, if you look at smaller time frame charts, you'll see optimal trade entries on a lower time frame near the highs and the tops. They're going to be there because it's fractal in nature. Okay, it's going to be there. I guarantee you. We're going to look at some examples, because I know you're probably scratching your head saying, okay, this is great, you're just showing me a line chart, Michael, but I really want to see, I want to be able to digest what you're showing me, and I'm going to get to that. But this is the theory. Okay, so we have to have this before we go into the price chart, otherwise this is going to look like I'm cherry picking. And eventually, price will move outside of the consolidation and into a trending move again. So we move from consolidation to trending move to consolidation to trending move. Now we have a complete fractal on a higher time frame. Inside of this overall price structure, this pattern can be broken down into smaller subunits on the lower time frames, and you'll see the same pattern you see here on the lower time frames as well. By having this perspective going into your analysis, having it on a higher time frame first and then moving down to a lower time frame, it helps with your daily bias. It keeps you on the right side of the market generally, unless there's a major market reversal. But hopefully, if you're monitoring the macro review anyway, you should be anticipating that anyway, unless there's an act of God or something unexpected takes place and rocks the market. Okay, so we have our fractal pattern here. It's a downswing in price. It's a swing that you can see in any time frame. It's not limited to any specific one, but what would it look like in a real chart? Well, it just so happens that I'm looking at the cable, and we're going to use today's example, so it's more timely. It's something that you can look at right now. I know some of you probably are watching this video probably years from the time I did the recording, but as of the moment I did this, I screen captured what price was doing, and this is a 15-minute chart of the cable, British pound USD. All right, and if you look at this, we have a major resistance level here, 163. Price trades up to that, much in the same way our crude example to the left shows. Price goes up, comes down, okay, and then comes up and makes another attempt to get back to that resistance level, but it fails, and it gives you an optimal trade entry. Note this low right here, and now note the fractal example in the upper left. That's that low that would shift everything to bearish, okay? That is broken here. So now what you would be looking for is optimal trade entry sell patterns, because now you are in an established bearish market, okay? Everything you do from that point on should be looked for selling, okay? Even your scalps, okay? If you're an intraday trader, look for smaller short-term optimal trade entry sell signals, okay? Focusing on one pattern in fractal in nature, you can find several opportunities in this example alone that gives you optimal trade entries. For instance, this optimal trade entry that we see here, when it broke this example of market flow changing to bearish, this swing high has to break before it becomes bullish again. Price moves lower, trades up, and inside here, just this small little time frame movement in here is a small optimal trade entry in here, and sells off. Look at this high here to this high here, and this low here. Do you see how price trades down, up into an optimal trade entry, and then look at the sell-off? See that? Look at this high here, and this low here, and this high here. That's optimal trade entry. Okay? Look how many times it gives you optimal trade entries just in that small section of time. See this high here to this low here? Price trades down, comes all the way back up, optimal trade entry, sells off again. Look at the price structure here. It trades down, comes back up, optimal trade entry again, sells off. You see how by using a higher time frame premise, you can use fractal analysis to keep you on one side of the market, keying off of one specific approach to trading, in this case being a seller, and it will keep you more or less, with the right bias. Okay. Now, notice the high to low here. Okay, this high to this low. This is one price leg, or one major dominant price swing. Then we had a major retracement deep in here. Okay, if you go and look at this high here to this low, we have a optimal trade entry. Okay, so now think about it. We used the fractal pattern here in this leg here, but now zoom out and don't look so close. In other words, if we move maybe to an hourly chart, you would see this high to this low up to this high as a fractal pattern in the same capacity it shows here. Okay, so this high to the low would be more or less established in an example of this high to this low, and this low to this high would be crudely exampled by this low to this high. So watch what happens. The same concept is now going to be applied with this price swing from high to low to high. This is the low. Market structure breaks down here. Okay, see this low? It breaks right there. So now what do? You look for optimal trade entry shorts. Here's your high, trades down to a low, starts to run up. What do you expect? Optimal trade entry. High, low, here's your retracement, down. Look what happens again. See this high to this low? Optimal trade entry, down. Okay? Same thing here, very short term. High, down to low, and in here, and this is where we start to see what? A breakdown. It did not fulfill. Look what happens here. See what's happened? We have this high turn. So now we have a probable change in direction where now market flow has shifted to bullishness. So this fractal is now a replication of this price swing. So if we look at this high to this low in terms of pip magnitude, in other words, the price swing, it's replicated in terms of distance. In other words, this range from low to high is essentially the same thing you see here, this high to this low. Market turning points. All right, we talk about market flow and we talk about market structure, but without having it understood on the actual individual candles or bars, it could be a little unnerving to some folks that are just starting to watch this and scratching their head thinking, what am I supposed to be looking for? Well, regardless of what time frame you're looking at, okay, if you have a pattern that is looking for a sell scenario, okay, you're looking for a sell scenario, there are several opportunities to use price to get you into a move. Okay, and for instance, we're going to take this is a turning point for a sell. As price runs up, and we're going to be assuming that this is a resistance level up in here of some kind, and maybe this is a 5-minute chart. Okay, you zoom down to a 5-minute chart into that resistance level at a time of day when you would expect the turn to take place, for instance, London, and we see the price run up. Okay, on this one candle here. So it's going to represent in this example a 5-minute candle. Then we see the lower candle here form. So now we have a 5-minute swing high. Now price will come down, okay, and it may even come up here. Now what does this look like? This would be what? An optimal trade entry sell signal. Okay. In here, we have another short-term swing high. This is a high with two lower highs. I'm sorry, with two lower highs on either side of it. So if you see this pattern, okay, in this whole range could be as little as 5 pips, 10 pips, okay? You could be selling right here on this candle at market, okay? Or you can use a break below this candle here on a sell stop, okay? So if you break down here, this will be selling on a stop or selling at the market, okay? Or using this low here, okay, because we have a low with a higher low on either side. This is a swing low. We can use this low as an indication to sell on a limit at this price or higher. So if, for example, we'll say this is the cable, and this price is 161.50. We could have a limit order to sell at 161.50, and on this candle right here, once we see this candle close and it starts to open up here, entering a limit order at 161.50 to sell would fill you on this candle, and then we would expect and anticipate price to break down below this low. And if we see that, that's what you expect to see in market turning points, and then you can look for range expansion to the downside, and then manage your stops above the respective the highs up here as well. Okay, obviously the same thing applies as reversing it. If we are expecting bullishness in the marketplace, we're going to assume that there's a support level down here. We wait for, again, this is a 5-minute chart. We could see a low with 2 higher lows on either side of it here, and price runs up, okay, and eventually starts to come back down again in here. It doesn't have to do this, okay. You could just use the previous swing high here and If it breaks that, obviously that would be what you're looking for. But you want to be getting in before the expansion takes place. You want to be getting in when prices on a tear, starting to run. You want to be in before that. You want to be in the accumulation phase like we have here. This is a consolidation. You want to be in that, okay? So if we do get an opportunity where it comes back and gives you a smaller short-term little optimal trade entry in here, that's ideal, okay? So you can use this swing high here, buy on a stop above this high here, or you can put a limit order at this price or lower, okay, to get in long. And then obviously using the swing low and 30 pips, 20 pips, whatever your risk management is going to permit you for the trade to do your long setup. And then obviously you anticipate, once you get in the move, you anticipate expansion, and then when you start seeing these short-term swing highs break out, okay, then you have what you expect to see in your trade, and then hopefully you reach for your upper objectives in price for your profit taking.